The broadcast is now starting. All attendees are in listen-only mode.
Good morning. Welcome to the Infrastructure Journal online seminar. I'm McGuirk, a news editor at IJ. Today we'll be discussing opportunities and challenges in the European utilities M&A market. I'm now going to hand over to our chair for this morning, Bennett, who is a Senior Vice President in the Infrastructure Practice at Marsh. Martin, please can you introduce the panel?
Good morning. Thank you, Catherine. This morning we have Marcus Hottenrott, who is Managing Director and Chief Investment Officer of Morgan Stanley Infrastructure, and also with me Philip Roberts, who is Head of Energy and Natural Resources within the Structured Finance Office of Bank of Tokyo Mitsubishi. We hopefully will also be joined by Daniel Wong from Macquarie, who's been slightly delayed on his way to the meeting this morning. So thank you for joining us this morning, Marcus and Philip. And the subject is European utilities and the M&A opportunities and analysis around those. Starting off by looking at the market, we've seen M&A activity within the European utility sector increase over recent years through, I guess, a number of factors. Partly unbundling regulations have forced the divestment of transmission distribution networks by generators. In other situations, some of the regulated utilities have become more attractive to their owners as a divestment proposition as values have increased. And there's certainly been a significant increase in activity across a number of countries, both those which are perhaps more established economies as well as those which are emerging and perhaps going through privatisation processes for the first time. Perhaps if I could start with you, Marcus, and perhaps just give us a little bit of an overview as to how you see the current climate for M&A activity in Europe in the utility sector. Which particular asset types do you see as the strongest for investment, and potentially which countries may be seen perhaps the most attractive within the region?
Thank you and good morning, everyone. The themes driving are the ones that you mentioned. In addition to that, capex requirements as at least some countries changing the energy mix away from nuclear, focusing more on renewables with the required capex. Utilities looking for higher profitability in more riskier areas and therefore more on the generation side, as you said, unbundling regulation, non-discriminatory third-party access regulation. Has changed strategic thinking on the core infrastructure, in particular the grid infrastructure of those players. I wouldn't say that there is one geography that is generally more attractive than others. I mean, in the end, of course, it comes down to regulation. The most developed, most predictable regulation, probably in this country, in the UK. At the same time, the UK is probably the most competitive market, just because it's the easiest for everyone from around the world to transact here. Then it depends on the focus of the respective investor, right? Whoever wants to buy assets and is happy with 8-9% that levered may find very clean infrastructure assets here. Somebody who is willing to take maybe a little bit of, let's say, a little bit more regulatory risk, may go to another country in order to find this pickup. But ultimately the M&A pipeline is so bulky, so bumpy, that it's hard to say, let me focus on this particular asset class in this particular country. To a degree, you need to be opportunistic and look at everything that comes, across the radar screen. It's clear that utilities at this point of time, is the most active sector in the infrastructure space in Europe.
Okay, and you touched on regulation there as being perhaps a key consideration, key driver investment activity. See regulatory environments differ by country, by level of sophistication, particularly as you perhaps go further east in Europe, purely through lack of history of operating in a regulated regime. How do you assess regulatory risk when you're considering an acquisition within the utility space? And what are the key positives that you're looking for in a regulatory regime to actually support an investment?
First of all, how do we assess a regulatory regime? I mean, you look at the regulatory performance, regulatory predictability historically, and we generally work with consultants who have been in the respective market for many years. We try to talk to the regulator where this is possible. Ultimately, regulatory regimes can normally be priced in one way or the other, and that's an interesting aspect that regulatory regimes start to compete with each other. The starting point some years back was that there were some countries who wanted to attract more private capital for, let's say the utility sectors or infrastructure more broadly, and therefore started early with economic regulation, and at this point of time have sophisticated regulators who understand the needs of investors in particular in terms of predictability. And other countries, such as my home country, Germany, thought that most infrastructure would be provided by the public sector, and therefore didn't focus too much on the topic, and therefore I think back to the Vattenfall high voltage grid, right? When this process started, most lending banks said that this regulatory regime is not bankable. Right? This was when, like, only 4 years ago, there was a regulatory regime in Germany that people considered as not being bankable. Right? Okay, things have moved on. Nevertheless, the German regulator by now probably understands better that they compete with the regulation, in particular in the UK, but also in other countries. Once you reach a certain level of predictability, as I said, it comes down to pricing the regulatory regime, and the regulator who acts in the best interest of the customers needs to understand that the more predictable he is, and the more aggressively people are therefore willing to price that particular regulatory regime, the more it is in the interest of the customers who just pay less for the provision of the of the infrastructure.
Perhaps, Phil, if I can bring you in at this point and perhaps give a lender's perspective on the regulatory issues that Marcus has raised there. When you're assessing utilities from a debt perspective, what's your take on regulatory regimes, and how strong a driver is that in your assessment of risk?
Sure. Well, I mean, I guess it's an excellent space that we're talking about in terms of regulated utilities. I mean, from our bank's perspective, we're looking to globalize more, and certainly there's been a significant step change in that in the last 2 years. And the reason that the bank wants to globalize is because it wants to go into target markets with its target clients in areas where it feels comfortable, and risk appetite is a very key area for us. Traditionally, we've been project finance, which has been an area where obviously you have quite tight control, etc. Credit-worthy counterparties, but the whole regulated utility space is a perfect new opportunity for us because it hits the risk profile perfectly for us in terms of regulation. Where we assess the regulation, we have a look at it, and really for us, it's historic performance. It's the country risk in which the asset resides, and then equally our confidence going forward in that, in terms of can you survive downturns in the regulation if there be a change. And very important for us is a history that they are going to retrospectively change regulation, or if they do change regulation going forward, it's tweaks to regulation rather than value destruction regulation. So for us, it's countries like the UK. The UK is obviously a very strong your market has a track record both in utilities, in terms of transportation, and I think there's a lot of confidence in the UK there. We've done transactions in Scandinavia, again, wealthy countries who are looking for stability going forward as well. And then, as Marcus says, we're looking at France and Germany and countries like this, countries who are, in a good, solid position financially, and who can therefore support regulation with the ultimate aim of reducing costs to their consumers, whilst building out the infrastructure that those countries need. So it's that combination of factors for us which hits our target markets. And the one thing we will do is we will look at regulation across market. If we see a weak one, we will just avoid it. And when our clients come to us and say, are you interested in financing that regulation? We'll give them a quick answer. The answer will be, no. For us, we just go pass on this one. Other people may do it, domestic banks, etc. But for us, we just go pass on that one, and other people go.
There's one aspect very quickly. Country risk, European debt crisis, and regulation. I would see country risk and regulatory risk not necessarily always aligned. I look at Italy, for example. Country risk currently perceived to be very high. Regulation on the transport side, pretty awful. On the utility side, actually a fairly sophisticated regime. So, just to illustrate that things can, kind of be slightly different from just the pure country risk. Now, the European debt crisis has introduced some issues in regulation, and generally when we think about the sovereign debt crisis, obviously we think about whether the euro will remain together, or whether we, having made, let's say, euro investment, end up with investment in some other currency. But we also think about what the government may need to be forced to do on the tax side. But we have also seen on the regulatory side some unexpected developments, and I think the one that also Phil was referring to was the changes, and even retroactive changes to the Spanish renewables regulation. So the sovereign debt crisis has introduced an increased level of uncertainty in the countries that have, that are perceived to have particular country risk issues right now.
And do you perceive that there could be an issue with countries which, on the surface, have a very stable regulatory regime at the moment, that because of broader economic issues, there could be a motivation to adjust regulation and actually create a more unfavourable environment for the owner of assets to appease public perception, perhaps, around cost of utility services, etc. Is that a concern at all?
It certainly is, and I think we have even seen it in this country where the public applauded to kind of very aggressive steps of some of the utility regulators. So in particular in sectors where you have predominantly financial investors, I think financial investors were seen differently up to 2006-07 than they're seen now, and politicians will have a different view. Generally, obviously, all regulators should continue to be interested in creating regulatory regimes and living regulatory regimes that are as attractive as possible, because it over time should lower the cost of the provision of infrastructure to the customers, and that's really the mandate they have.
Okay, that's good. I'm delighted to say that Daniel Wong has been able to join us now for the discussion. Daniel is Head of Infrastructure, Utilities and Real Estate at Macquarie. Good morning, Daniel.
Good morning.
Thanks for joining us.
Sorry, I'm a little bit late.
Perhaps if I throw a question at you to warm things up. We've just been talking a little around the regulatory environment for investing in utilities around Europe. From Macquarie's perspective, and when you're assessing M&A opportunities in utilities, discussing the relative merits of one regulatory regime, one country to another. How do you approach that subject?
Oh, very good question. I think when you look at regulatory regimes around the world, which is I think the scope of the review, the UK I think is in the water, gas, electricity transmission and distribution. It's one of the most mature, it's one of the most predictable, and arguably one of the more attractive places for infrastructure investors to invest. So quite often when we talk to our clients about how does one country compare to the other, we often find the discussion heading towards how does country A, B, C or D compare to the UK. And why is that the case? I think first and foremost, I think the key is to make sure that the capital that is invested is protected, and secondly that there is an adequate return. And I think that's how you compare many of the different jurisdictions, and the UK has a certain level measured in terms of WACC. In Germany, for instance, there's a return that investors get, but is largely linked to the return on equity. And then as you move to the Scandinavian countries, say to Spain or what have you, the regulation is all slightly different, but fundamentally it's all about protecting the capital that's invested in an appropriate level of return. The other important consideration is that the costs associated with running the infrastructure or regulated infrastructure is covered. So the simple principles of cost pass-through are important, and again the UK it's relatively straightforward. Interestingly, the German and regulatory environment has been one where some recent developments have actually moved from not full pass-through of costs or perhaps a time lag in the pass-through of costs to the owners of the infrastructure through to now what is a much more timely and fulsome pass-through of those costs. And what that does is effectively makes, again, the return on investment, return on capital an acceptable level, or else the valuation of assets in that regulatory environment suffer as a result. And thirdly, I mean the list can go on, but thirdly, and perhaps also extremely importantly, it's stability. What Mark has referred to there, referring to say some of the renewable regimes, is the sort of thing that investors are concerned about. And a stable, predictable regime is an important one, and that ultimately translates through to the risk premium. And the risk premium ultimately translates through to the cost of that capital to provide the funding for the existing infrastructure, and importantly, the future capital expenditure that needs to go into that infrastructure. It's no secret that water in particular in the UK, transmission all around Europe, and in some cases gas distribution as well, all require huge amounts of capital expenditure, and for that reason I'm perhaps a little bit more, well not more, but I'm quite optimistic about how regulators will interact with the investment market, because ultimately it's not just a case of remuneration for past investment that's been made, it's also remuneration or returns for future investments that they're looking to attract.
Perhaps if we can talk a little bit about the competitive nature of the M&A market, since we're looking at a subject around opportunities and where they come from, and I guess potentially who the owners of assets may be following an M&A process. Obviously there's a very established infrastructure fund community, to obviously people sitting here with us in the discussion this morning, but there's also been the development of the direct investors over recent years. Whether they be Canadian pension funds or other direct investors, other sovereign funds from around the world. What are the dynamics that potentially make an asset more suitable for a direct investor rather than a fund, or potentially identify synergies where a co-investment might be an appropriate way to take an asset ownership forward.
I might go first. I should just clarify, I work in the Macquarie Capital part of Macquarie. So the business that I run is the advisory part of Macquarie. So our client base basically covers the whole scope of or range of those investors that you've just described. There are the infrastructure funds, such as Marcus's. There are the pension funds who invest direct, of different size and of different experience. And then there are the pension funds who invest through infrastructure funds. And then there are the pension funds, I should have said pension funds in insurance companies and sovereign wealth funds. Then there are the funds who invest but follow other lead investors, but also are direct investors. So the market, I mean, the market's a maturing market. I think infrastructure funds are starting to reach the end of the first generation. So it's still relatively new in the concept of private funds, but it's still maturing. And what we're finding in terms of our client base, there are the infrastructure funds that have specialist management teams who are looking for investments that they can manage. So what I find is quite often this client base looks for controlling type situations. So more than 50%, ideally 100%, to really own and make a difference to the operation of the company that they're investing in. All the way through to the other end of the spectrum, we're finding that there are some direct minority investors who tend to be the pension funds, insurance companies, sovereign wealth funds, who invest either in partnership with infrastructure funds, but alongside them, or interestingly and an increasingly emerging class of investors who invest alongside an industrial. And they tend to want minority governance rights, but ultimately, after their investment is made, they invest alongside somebody else who takes quite a stronger lead in the investment going forward. And then obviously there's everything in between. But the opportunities that present themselves to the market at the extreme lend themselves to those two different markets. And you know, from our perspective, we spend a lot of time trying to source opportunities in both areas for our clients.
Marcus, well, ultimately the competitive environment is one for every different asset, right? And for every opportunity you need to assess as a fund manager, but also as an M&A advisor who needs to pick the right horse to ultimately be the advisor to the winning bidder or the winning consortium. We need to assess whether we can be competitive or not, and we will think about how we compete relative to direct investors who in many cases have a lower cost of capital than us. So a very clean asset in a AAA or very highly rated jurisdiction where there's relatively little to do, it's unlikely that we will be competitive. And we have limited resources, and running processes costs a lot of money. So we will stay away from a process like this. Right? At the same time, there are situations where things are fairly hairy for whatever reason. And when I say hairy, predominantly kind of operationally hairy, where it's likely that most direct investors, pension funds, insurance companies, sovereign wealth funds, will stay away or will want to partner with a fund manager and kind of alongside them. But where generally we should be able to be very competitive, and where our competition will likely be other infrastructure funds, right? And then there's this area of gray where there's something to do that may allow us to create value and satisfy our slightly higher cost of capital and still be competitive relative to the direct investor, who in many cases will value the business on an as-is basis, but apply a lower cost of capital. So we run through this analysis time we become more serious about an investment opportunity.
Okay, thank you. Perhaps if we can move on now to look at some of the financing challenges in infrastructure, particularly the dynamics around the debt market and the changing face of debt for infrastructure investments. Over the last 4 years or so, we've seen huge changes in the capability of banks to finance long-term infrastructure debt, changes that potentially could involve many alternative sources of long-term debt finance other than traditional project finance. Philip, perhaps could you run through the debt market as you see it at the moment, and perhaps where the most innovative approaches will be for the future of the long-term financing needs of these utility-type assets?
Sure, no problem. I think we're in a fortunate position. We're obviously a well-capitalized bank with strong liquidity from our Japanese investors. So we still have the ability to do long-term debt, and we're very happy to do that with our clients on transactions going forward. But we have to recognise that not all banks are in that position. And so where we see, particularly with the regulated utilities, is we're seeing that as being an area which has gone very short to medium term in terms of the acquisition finance which gets put in on day one. And for us, we're very happy to play in that space. We're very happy to take the refinancing risk. And if that's the place where the other banks are, that's a positive place for us to be as well. For us, where we see that acquisition finance market, it's very interesting because it's still in a state of movement. And what you see is a combination of classic investment banks who are looking to do the DCM takeout, take the M&A mandate perhaps, and advise their clients and get out of that business as quickly as they can, if they're successful, versus your traditional project finance banks who are looking to assess the business on the long term, see what the control is. And I think that adds an interesting dynamic to any bank group when you're sitting in there. I like to think that we're sitting in the middle somewhere where we understand the advantages of looking at the business and seeing what the refinancing risk is from a cash flow perspective, but fully recognising that the immediate takeout opportunity is the debt capital market, and therefore the importance is to structure your initial acquisition finance. Look at the metrics and make sure that there's a DCM investment grade rating to facilitate a quick takeout. So within that dynamic, where we're seeing is people going for 3-year, 5-year debt, 3-year bridge facilities pricing through where you might see a bond being priced, a 5-year debt or longer, with higher initial pricing, more at a sort of medium-term financing level, with perhaps a little bit of amortization or cash sweeps kicking in at the back end just to incentivize the refinancing at that point. But the two dynamics of a bank group like that is quite interesting, because there is one which is people just, one group just wants to get out within 18 months. So, is it that you've got a rating pre-acquisition? What are the metrics? What's the investor appetite going to be? What's incentivizing the sponsors to do that refinancing, whether it be duration fees, etc. And then you've got the other group who are, as I said, looking for more control, looking for more cash flow protection. And I think there's a happy medium, in the middle, which is you have to acknowledge these are regulated utilities. A lot of them may be RAB-based. These are growing businesses with capex going forward. These don't need to be amortized off, and they should therefore be refinanced. But then again, at the same time, those banks looking at that need to be brought into the loop because they're a source of liquidity, a very valuable source of liquidity, so it can bring quite a lot to the party. In terms of what those financings take out there, I think again it comes down to choosing your market where you think you will be able to get a ratings takeout, and that's where I think retrospective regulation changes have seriously harmed the appetite for certain markets, on the basis that you now have very little investor confidence that there would be the ability to do a takeout, and therefore I think that does focus you more towards Scandinavia, France, Germany, etc., as places, and of course the UK, as places where there's a demonstrable takeout market which you can have confidence in.
Just from an equity perspective, you touched on a number of interesting things, Phil, and we followed the developments of the debt markets, very closely, because first of all, there are situations where financing is not as readily available anymore as it possibly was the case some time ago. Not so much in utilities, but more in other areas, and therefore we need to think about alternatives. Secondly, you mentioned many times the takeout, right? Banks are much more focused nowadays on effectively velocity of capital and therefore refinancings, and obviously any need to refinance or any economic pressure to refinance means risk for equity, and that's introduced through Basel III and other aspects. And so we follow very closely the emergence of debt funds. Right? I mean, every institution currently thinks about raising a debt fund. Right? In different segments, some only want to do secondary stuff, and some want to be primarily in mass and junior and so forth. But a lot of them are also thinking about primary, senior instruments. The private placement market. Frankly, the bond market is underdeveloped in most markets. Frankly, in Europe, with the exception of the UK, right? So, what is going to happen there? There's certainly investor education ongoing. How is this market going to develop? And then, in order to eliminate the refinancing risk, what is maybe the financing market into which we can tap, and immediately implement the permanent long-term capital structure that eliminates the refinancing risk, which is a risk that we take very seriously and that we also need to price, right? To date, and my prediction is that it will remain the same in the future. To date, the banks have proven to be the most efficient and therefore the most kind of cost-effective provider of acquisition debt. But they come in many cases with the challenge of having to refinance relatively quickly, and relatively quickly means you get normally 5-year maturities, but in many cases the pressure starts after 2 years or so, the economic pressure to refinance.
And I guess the emergence of debt funds for infrastructure is it's an interesting dynamic. Certainly we read every day, or it appears to be every day, around new entrants to that space. Daniel, from your perspective at Macquarie, how do you see the emergence of debt funds as a long-term source of stable debt capital for the sorts of assets that you're advising your clients on?
Yeah, I think the debt funds are coming. Some have arrived, and I think they will form a permanent part of the landscape going forward. And when we look at the market generally, we see that it makes a lot of sense, because we've spent, up until this topic, we've spent a fair bit of time talking about the pension funds, insurance companies, sovereign wealth funds, and their interest in investing in infrastructure equity. And the case for that is well discussed throughout throughout everywhere, that their long-term stable cash flows linked to inflation that match the liabilities. Interestingly, debt in these assets also broadly carry the same characteristics, but historically it has been the market for, particularly in Europe, for the banks to provide that financing. So in really big picture terms, that market of banks providing that debt financing is withdrawing, or is contracting, both in terms of by number, by quantum, and by tenor. So really it's become much more attractive for the remaining market to look at that opportunity. So fundamentally, I think it's the institutions and pension funds who are interested in stepping into that space. And that's the first step that then ripples through to the fund and asset managers who who then raise the debt funds off the back of that demand, and then they will go out and source the opportunities both in the primary and secondary market. So from our point of view, we already interact with a number of these debt funds, and we're increasingly seeing new ones coming to the market, and we expect them to stay. The other interesting thing is as the traditional lenders to the market are withdrawing, we're finding as Macquarie Group, we're finding that our capital is at times also appropriate for helping clients finance their acquisitions, particularly where in Europe historically it's been a little bit further up the capital structure, so more towards the MES end of the spectrum. We've recently provided financing or committed to financing for one of our renewables developers clients, Mainstream Renewable Power, and in the US we regularly provide acquisition finance because in that market it's a little bit different to the European one. It's a bridge to a bond takeout, and we recently provided the financing for the acquisition of Veolia's waste business, for example. So yeah, look, even our business is evolving to move in ways to fill in that gap as well.
Okay, thank you. Perhaps I guess a sort of follow-on question. The need for investment grade ratings around utility assets to effectively make the debt pricing as attractive as possible. Where there are assets which perhaps on the surface don't achieve an investment grade rating, what are the mechanics that can be deployed to actually lift the rating, actually improve the risk profile of an asset such that it becomes more attractive from a debt perspective?
Really, to take the first point, I guess the reason why this space is seeing quite a lot of acquisition finance is because it's already well suited to getting the investment grade profile, and the combination of security, the combination of covenant packages, the concept of being able to have a security and a ring fence, that all adds rating uplift to what the underlying financial metrics may or may not say. So I think from that perspective, this space, in good jurisdictions with solid regulation, that can tick the box for the rating agencies and get that investment grade. I think when you maybe move away from the regulated utilities into some of the other sectors, I think your question is, do they tick the investment grade profile by themselves, even with uplift? Is debatable, and I don't think anyone wants a BBB- type of deal, or in fact you wouldn't want to make an acquisition on the back of, well, I might just squeeze to BBB- because that's not going to give your banks who are providing the acquisition financing any confidence. Clearly, I mean, there's institutions out there, Hagen's Hall being a good one, where they take the subordinated cash flow piece to allow you to have your senior piece achieve the investment grade rating. I think that's something which we will continue to see develop. I don't think it's necessarily in a regulated utility space, but I think that's much more a space for single asset, project finance, PPP, PFI, project bonds. I think that's an area where we'll see that market go, because they single assets may not just get you to the cusp of a strong confidence in an investment grade, and then there may definitely be a place to play for those funds.
Again, from the equity perspective, there are really two aspects why we would think about the rating outcome. One is what we just spoke about before, the need to get out of the bank financing and therefore to refinance, and ultimately where the rating ends up being is a risk for equity, but also in structuring the deals, the banks will insist that they have an easy exit, and at BBB-, there's obviously more risk than at BBB that things could deteriorate and refinancing could be more difficult. From an equity perspective, more broadly, generally we wouldn't worry so much about the assessment of the rating agencies. We think about the appropriate capital structure for an asset. And it makes a difference whether there's a refinancing risk or not, or whether we can, out of the box lock in, a very long-term financing that gives us, effectively that lets us sleep at night with respect to refinancing risk. And this is an area where, over the last few years, we have seen a significant change in thinking of equity very broadly, in that capital structures were obviously much more aggressive in the past than they are now. And that's not only a question of the banks being willing to provide these aggressive capital structures, but I think investors more broadly, equity investors more broadly, take a different view with respect to a different approach with respect to capital structure, in that at a certain point people feel that you don't create additional value through leverage. You just maybe increase in your financial model the IRR, but you're really only being compensated for the additional capital structure risk that you take.
Indeed. Daniel, any thoughts there?
Well, I just echo Marcus's last point in terms of there's not a lot of value that equity we observe our clients see in that additional leverage. But an interesting development in the reverse direction, actually, which is probably less so with the infrastructure funds, but more so with the direct institutional investors, where there are investors looking for super low leverage. And that's using the rating scale, where an infrastructure fund might aim for a deal that might be circa BBB+. The direct investors, institutions, when they invest, we observe, tend to target capital structures in the A+ range, which obviously implies lower leverage. And then there's an even further class of investors or clients that we deal with who are interested in even lower leverage than that, because they're seeing, on a risk-adjusted basis, it still makes sense for them. And for these investors, their investment criteria tends to match up with some large corporates who are looking to sell down minority positions in their infrastructure assets, because large corporates, whether they be utilities or concessionaires, as the case may be focused on not raising the higher amount of debt in their assets, but keeping it at a low level so they can fund a lot of the debt or the capital at the corporate level. So we see this emerging class of transaction structure that that lends itself to extremely low leverage.
Okay, thank you. What I'd like to address as a final subject before we take any questions is effectively just looking around Europe and looking around the broad utility sector. Perhaps each of you in turn could give your thoughts on, firstly, are there enough M&A opportunities around to meet the demands of the investment community at the moment? Is the quality of those M&A opportunities at a level that makes them attractive across the region for the investment community? And just a bit of crystal ball gazing, where do you see the M&A environment may go to over the next perhaps 2 to 3 years from now? Perhaps, Marcus, could I start with you?
There is significant activity, M&A activity in the utility sector in Europe right now. Having said this, I think we have seen a bit of a slowdown, certainly compared to other years. And frankly, when I look at the situation, some of the situations right now, not even just utilities, but more broadly, that there are a number of pretty complicated situations out there in terms of geography, in terms of certain customer risks, and so forth. The reason why utilities is such a focus is that other subsectors of the infrastructure asset class, in particular transportation, are more GDP geared, and therefore in an economically uncertain environment, it's more difficult for buyers and sellers to agree on the views and therefore to agree on price. And in utilities you have less volume risk, but you do have in many cases still volume risk, and therefore the economic uncertainty plays into this. I could see that as hopefully the situation in Europe improves, and in my view that's not a near-term event, that the market, that the market with the increased visibility for the economic outcome will, that the market will provide more M&A opportunities. And you mentioned 2 to 3 years. Well, maybe it's towards the end of that period that we reach that increased visibility.
Okay, thank you, Daniel.
Well, I think I'm probably one of the more optimistic voices in terms of M&A activity in this sector, and I'd actually include all of power and utilities and renewables. I'd include midstream energy as well as resource infrastructure through to transportation infrastructure, actually, and social infrastructure. And the reason for that is because I think there are some really long-term, big-picture trends that are grinding through the whole market at the moment. On the demand side, there is an increasing attention, recognition, and importantly, allocation of capital from institutions and pension funds into the infrastructure asset class. So the demand is just increasing. On the supply side, which is probably the one to really focus on, because that will control the timing, in my opinion. On the supply side, they're traditional owners of infrastructure, which are these large listed companies, and we'll come to governments in a moment, but the large listed companies are having difficulty accessing capital by their traditional means, because the cost of capital is implied by share prices of utilities and construction companies, concessionaires as the case may be, just simply implies a high cost of capital. So they need to generate a higher return, and as we know, infrastructure, whilst it's long-term stable, cash flows actually generate a lower return for them. So the long-term push of these asset classes off their balance sheets is coming through. The same, in addition to that, I guess, is the unbundling laws across the EU, where utilities in particular are forced to sell their infrastructure. In addition to that, a number of the utilities that we deal with have committed, through regulation, through social conscience, huge capital programs to build out renewables. And that's before you add their own capital programs to refresh their conventional generation fleet. So they've got huge capital demands on their balance sheet and their business going forward. So in my opinion, they will focus on those sorts of businesses where actually they have much greater expertise and much more value add and obviously higher return to meet their cost of capital. And the infrastructure assets will continue to flow onto the market. But the issue that is, I think, constraining some of the deal flow at the moment, which is slowing things down, is the fact that we're living in Europe right now. We can go to the other jurisdictions, but we're in Europe here. In Europe, there's a bid-ask spread that has emerged through the fact that some currencies are difficult for the demand to invest in. Some of the regulations become a bit unstable. And as a result, the owners of the assets are having a little bit of difficulty ushering in the demand to hit their target pricing. And that's, as we all know, in a either flat or slightly declining market, it's very difficult to consummate transactions. And I think that'll slow things down. It has been slowing things down for the short while. And I think as the macro situation across Europe stabilizes, I think that will just push through, because the underlying themes are very strong, and I think will continue to be so for 5, 10 years onwards.
Okay, thank you. And Philip,
Yeah, so I mean, from our side, we're very busy, and I guess we're in the advantage that regulated utilities is one space we're active in, but then we have Middle East, which is continues to be a very, very strong area for us. Where we look at ports, airports, social infrastructure, PPP, and then on the energy side we have renewables. We do the offshore wind, as well as upstream oil and gas. So for us, when something slows somewhere, there'll always be someone knocking at our door asking for us to take some business somewhere else.
My apologies there, we had some mild IT misfunctions, either that or somebody had to pay the phone bill here. But we're back with you now, and just concluding, Philip, can I just go back to your final point there?
Sure, so I was just saying that we're obviously a bank who can hold and take longer positions than others, which means therefore that if there's a deal which needs some structuring, which isn't a classic investment grade bond takeout, we're very happy to roll our sleeves up and get involved in those, and we see a lot of clients come to us who say, look, I don't want to take a refinancing risk on this in year 3. I can't give anyone any promises that this is going to be ratings, and that cuts out a whole swathe of the financial community. So for us, we see a lot of transactions. There may only be 3 or 4 bank deals, but that keeps us going as well, and that can be an area, offshore wind, renewables, upstream oil and gas. Those sorts of deals are areas where we're seeing a lot of activity going forward as well.
Okay, thank you very much. We can move on to Q&A now, just to conclude the session. Catherine, I think you've maybe been compiling some of the comments that have been coming in.
Yes, I've got a couple of questions, and also if anybody's listening in who'd like to take this opportunity to submit a question via the box on the screen, you're very welcome to do that now. My question to you all is, are there any particular regions within Europe that would be completely off limits for investment or for lending to? And if so, which are they and why?
It's a loaded question. I mean, there's certainly areas which we're very cautious on, and I think we will always bank our core clients, where they are, but in certain markets at this point in time, I don't think they're going to be making any investments in those regions, and therefore, the answer is that, without doubt, there's a couple of areas where we're just being very, very cautious and not looking to add exposure at this point in time.
And is that the nations that are particularly economically challenged?
Not really. I guess there it's a question of what the context of exposure is to certain countries, and then equally it's a question of risk appetite, for deals going forward, and then it's a clarity of regulation, etc., in terms of whether we have confidence in that over the long term, because again we are a long-term player, and those are all the assessments that we'll make in terms of deciding whether we want to take a market or not.
But to be very clear, in the end it comes down to whether a certain risk is within the mandate of an investor, and there's obviously different debt to equity, but from an equity perspective. And secondly, whether we can achieve a good risk-adjusted return. So, and that's a point I made earlier, while the UK regulation in many utility asset classes may be the most attractive, doesn't mean that I can generate the best risk-adjusted returns. In the UK being, without doubt, the most competitive market in Europe as well. So, just to clarify, because we are an investor who targets on a portfolio basis 12 to 15% IRR, there are probably certain jurisdictions right now, the very financially stretched ones that are off limit. That doesn't mean that one couldn't do attractive deals there, but it unlikely would be, kind of an infrastructure or core infrastructure investor like ourselves. And even where the financial stress on a country is, less strong than maybe in some other cases, I think we would assess how independent a regulator is, right? In a financially stressed environment where the regulator, reports to the ministry or sits within the ministry and is therefore subject to political change and is much more exposed to public sentiment, it's maybe a situation that we feel less comfortable with. Another area that we think about quite a bit when assessing countries is, corruption. Right? Again, as a 12 to 15% IR investor, we have no appetite to take on, an environment with very significant corruption, and unfortunately, there are some of these geographies also in Europe.
Okay. Annie?
I'll leave that question alone.
Okay. There's a question come in from the panel. Are offshore grids interesting, and in which countries?
I mean, certainly for us, offshore grids are interesting. We're very involved in the offshore process in the UK. In a way, it demonstrates exactly, a sweet spot for us. The process, the tender process encourages long-term debts to be put in place on day one, which limits the number of people who can do that, and we're very happy to do that. But without a doubt, the regulation is suitable for the capital markets takeout. So, if one of those comes along and gets taken out, brilliant, perfect for us, very happy with that. At the same time, we can leave the long-term debt on there because we're very happy with the process. I think other jurisdictions, Germany is an interesting one. We'll see where that comes out. Obviously, there's some challenges around offshore grids in Germany at the moment. But again, somewhere which we're comfortable that everything's moving in the right direction, and an area we'd like to plan.
Yeah, look, echo that. The offshore transmission cables are really interesting and emerging infrastructure class. They're not like a transmission network. They're very much a dedicated single-purpose piece of infrastructure. And as a result, they lend themselves to very stable utility-style regulation. Indeed, it actually is risk profile-wise very close to PPP-style availability-based type risk profile. We've been active in the UK market, so across the various OFTOs that have been tendered. We've been working with a couple of clients there, the Barclays Infrastructure Fund and Mitsubishi Corporation. It's been a fantastic experience to date in terms of the what I call the easier ones being sold, and then there's obviously the next phase which relates to the transmission cables that are still to be built for big offshore wind projects that are also still to be built. So there's a huge amount of capital to go into those projects. Germany is probably the next closest, I think, in Europe, but Germany is a little bit different. It's actually the utilities taking the lead there in terms of having to take the lead to move their, I guess, their capital requirements partially off balance sheet. And interestingly, it's not the German utilities for the German offshore transmission, it's the Dutch utilities that are doing it. But the concept is still the same, and our client base, in terms of the people we interact with, are very interested in it. But they tend to be towards the lower risk, lower return end of the spectrum.
Interestingly, Danny, when you talk about the almost PPP style of availability structure for the UK offshore grid regulations, that's been evolving over the last 3 or 4 years or so. Do you see that as a model which will roll out to other countries and effectively taking the de facto regulation for new offshore developments?
Interesting question. The one thing I've learned, having dealt across both the UK and Germany, is that the German regulator is very confident in their own views and their own unique approach to regulation. So I'm sure the UK experience will feed into their consideration, but ultimately they'll make their own mind up. And as a result, they could end up quite different. I think the OFTO's experience has been a successful one. It's proven to have accessed, for the funding of these pieces of infrastructure, a lower cost of capital than if they were built by the incumbents. So I think that's something to reflect on, actually, in terms of whether this is a useful model not exactly the same, but the concept is whether it's a useful model for funding other discrete pieces of infrastructure across the UK and beyond. We're actually seeing, obviously we've dealt in Germany with clients around those situations. Whilst the regulation is different, the situation is the same, which is that the regulated utility is separating a piece of their network and looking to raise capital into it separately. And I think what they're finding is that they're finding or they're accessing capital that's cheaper than if they were to do it themselves, which has to be a positive thing for the infrastructure.
But obviously, that touched a lot on the grid connections, and then there's also the wind parks per se, right? Where in the UK you need to become comfortable with the ROCs regime. In Germany you have kind of 14 or kind of 9-year feed-in tariffs that, by the way, are not inflation linked. So and generally the build-out, the construction of offshore wind parks is still something where people face challenges, in particular delay challenges, and where there's limited experience in terms of the impact of the salt spray, the kind of the stability of the foundations, and so forth. So it remains a challenging sector.
Yep, and they obviously sit on the end of these transmissions.
Okay, we have time, I think, just quickly for one final question, which is coming from the audience today, asking whether the panel sees geothermal in Germany as an attractive investment. Perhaps Marcus, can I start with you?
Yeah, we've actually looked at it. In the end, turned it down. I mean, frankly, in particular in Germany, it's economically not really a viable source of energy, which has to do with the fact that you need to drill very deep, and therefore the feed-in tariff is very high. I would claim so high that economically it doesn't make sense. And we looked at kind of the subsidy regimes that make things viable, because the more extreme they are, the higher the risk that something will change. Now, in Germany, I would have comfort that things will not change retroactively, but in geothermal, you, at least as an investor of the size of ourselves, you would need to build a portfolio, and you may buy 3 assets, and then there's a change in regulation, and the investment or the capex proposition isn't viable anymore. Aside from that, because of certain incidents, we've actually seen some opposition to drillings in Germany. So overall, we have passed on those opportunities that we've seen.
Would you concur with that, Daniel?
Well, our interaction with the geothermal market is with the developers. What we've found is that we are approached a lot by developers to help them raise finance or even provide finance during their development stages. The issue with geothermal, to date at least, is scale. It's not up and running yet in terms of developers having a large enough portfolio for us, in terms of our business, to really have much of an impact. It could change over time, but I think it's a much more early stage proposition at the moment as compared to, say, wind.
In Europe.
In Europe, yeah, sorry, in Europe.
Look, thank you all. We've reached our time limit now. So if I could thank Daniel Wong, Marcus Hottenrott, and Philip Roberts. Thank you all for your contributions. It's been a really good discussion. And thank you for all those who've been attending as well.
And I'd like to also add to that particular thanks to Martin for chairing, and to everybody listening in, and also to organising.